Ever feel like navigating the stock market's just, well, a total puzzle? There's so much advice out there, everyone promising the secret to getting rich. But what if you could get straight to some, you know, timeless wisdom, cut through the noise?
That's exactly what we try to do here on the deep dive. We dig into important sources, pull out the key stuff, and hopefully make it easy to grasp. It's kind of your shortcut to getting really informed.
And today, wow, we've got something fascinating. We're diving into the early letters Warren Buffett wrote to his limited partners. These cover a huge span, like 1957 all the way to 1995.
Yeah, and it's not just history. It's about understanding the bedrock, the foundations of how one of the, greatest investment minds ever actually built his success.
Exactly. So if you're someone who wants to learn quickly, get different perspectives, have those aha moments without getting bogged down.
And these letters, they're gold. It's like a direct line into Buffett's thinking in those really formative years, a time of incredible growth. And when he first started laying out principles that, honestly, are still incredibly powerful today.
And these aren't dry corporate reports either. Buffett gets into everything, market conditions, how his strategies changed over time, how he valued companies.
And his really candid views on the financial world. It's almost 4 decades of market history seen through this unique, super insightful lens.
So our mission for this deep dive, let's unpack these writings.
Let's find those core investment principles, the bedrock of his success, and maybe uncover some surprising insights that you'll find are still really relevant today.
All right, let's dive in. Okay, 1957, his very first letter. He had a pretty strong opinion on the market right from the get-go, didn't he?
Oh, absolutely. He was pretty convinced that the overall market, especially those big blue chip stocks everyone loved, was actually priced too high, higher than their real intrinsic value.
What they were really worth.
Exactly, based on future earnings potential. He even hinted a pretty big drop could be coming. But the interesting thing is, he wasn't focused on when it might drop. His main goal was finding specific companies whose stocks were cheap compared to their value, regardless of the market's mood.
Value in the specifics, not betting on the whole market.
Precisely.
And he wasn't exactly cheering on all the public optimism back then either.
No, not at all. He kind of saw that widespread belief that stocks only go up as a danger sign. His thinking was that kind of hype could inflate everything, even the undervalued stocks he liked.
Though not their actual underlying value.
Right. He was careful to make that distinction. Price and value, not always the same thing. A really key point he kept coming back to.
Okay, jump to 1958. It sounds like he expected his partnership to do better relative to the market when things were going down.
Exactly. He figured they'd probably outperform more in bear markets than in big bull runs.
Yeah.
In years the market soared. He basically said he'd be happy just matching the average.
That shows a very realistic view of their strategy. Protecting capital was key.
Very pragmatic, yeah. Focused on downside protection.
Then early 60s, we hear this term workouts a lot. What exactly were those?
So think of workouts as like hidden gems, undervalued companies or situations, but without any obvious, immediate, exciting news to make the stock pop. Because there was no immediate catalyst, you could often buy them really cheap. That gave him what he called a comfortable margin of safety.
A cushion.
A big cushion between the price paid and what he thought the business was actually worth. He was looking at intrinsic value, even in boring situations others ignored. Not waiting for the market, but buying value at a discount.
So the focus wasn't timing the sale perfectly, but getting that initial bargain price.
That's exactly right. He even noted their timing on buying was generally better than their timing on selling. They weren't trying to ring the bell at the absolute top. The goal was to sell at a reasonable level, somewhere between that low purchase price and what a private owner might pay. Recognize value, get a good return. Doesn't have to be perfect.
And Dempster Mill Manufacturing in 61, that's a concrete example, right?
Oh, Dempster is perfect. A farm equipment and water systems maker. Not exactly glamorous. Profits were minimal, but its book value was like $75 a share. Working capital was $50 a share.
Okay.
But the partnership valued their piece at only $35 a share, and they bought control at around $28.
Wow.
He saw huge potential if they could just get it moderately profitable. And this one investment, it was 21% of their total assets at the time. Shows his conviction in these deep value plays.
It's amazing. Even back then, 1961, she says he has not the faintest idea what the market will do next. Sounds just like the Buffett we know today.
Totally consistent. He always steered clear of those big market predictions. He knew there'd be big swings up and down over the next decade, sure. But he said the order of those swings, it didn't really matter for long-term investors focused on business value.
Keep your eye on the company, not the ticker tape.
Exactly. Focus on the micro, not the macro guessing game.
He also made a really important point about those early impressive results being distinctly abnormal. Why abnormal?
Yeah, that's crucial. He warned partners not to think their early outperformance meant they were brilliant market timers, because they had a lot in controlled assets, and these workouts, which didn't move perfectly with the Dow, they looked good when the Dow fell.
Ah, okay.
He admitted if the Dow had been roaring up then, their results might have looked pretty average, maybe even weak, relatively speaking. Success came from a specific strategy, specific opportunities, not market guessing.
And he set a clear time frame for judging performance.
Yep, minimum 3 years, ideally 5. He said if results were poor over 3 years, unless it was some crazy speculative bubble market, then, partners should probably look elsewhere.
Yeah.
He was clear. We're not in the business of predicting market fluctuations.
Even though the partnership grew massively, from about $300K to over $7 million by early 62, their outperformance margin over the Dow didn't seem to shrink much. That must have been encouraging.
It was. He tackled that concern head-on, the idea that getting bigger makes it harder to beat the market. He pointed out that, up to that point anyway, their relative performance was holding up pretty well despite the growth. Suggested the approach was still working, still scalable to some extent.
And he even gave expectations for different market conditions around then.
Yeah, that was fascinating. If the market tanked, say 35, 40%, or even 15, 20%, he expected the partnership to lose less. Flat market. He hoped for maybe a 10% gain.
Okay.
But if the market surged 20% or more, he admitted they'd likely struggle to keep up. His long-term hope. Average maybe 15% a year, much better than the 5% or so he expected from the Dow over time. Very realistic about their strengths and weaknesses.
And the fundamental reason for the partnership, he boiled it down.
Yep, pretty simple, really. Compound capital at a better than average rate, but with less risk of big long-term losses than other investments. And, amazingly honest, he said if they couldn't do that over a reasonable time, ignoring speculative booms, they'd actually just shut down the partnership.
Wow, that's accountability.
Huge accountability. A clear promise to his partners.
Okay, moving into the mid-60s, early 70s, strategy evolves, key concepts start to crystallize. Dempster Mill comes back in 63, but this time with a happy ending.
Yes, a very successful sale of Dempster as a going concern. The initial purchase was a bargain, sure, but he gave enormous credit to Harry Bottle, the manager he brought in, for doing an extraordinary job turning it around. Led to much bigger profits than expected.
So finding the value is one thing, but management realizing it is just as vital.
Absolutely crucial.
And that same year, 1963, he really hammers home the power of compounding, those famous examples.
Oh yeah, those tables showing $100,000 growing at 4%, 8%, 12%, 16% over decades. So powerful. The aha moment is just how massive the difference becomes from small percentage gains sustained over a long, long time. It's all about the long game.
He also starts formally categorizing investments: generals, workouts, controls.
Right, this gives a clearer picture. Generals were your standard marketable stocks. Workouts, we've discussed undervalued situations with a likely timeline. And controls, where they aimed for or already had a controlling interest. He also noted controls often grew out of generals, just buying more and more of an undervalued company over time.
And within controls, he mentioned having two strings to our bow. What's that about?
He meant they had two ways to win with those. First, the business might just appreciate on its own, better operations or whatever. Second, and maybe more important, by getting control at a bargain price, they can then actively influence management and strategy to unlock more value themselves. Kind of a belt and suspenders approach.
He also repeats that their portfolio mix wasn't about market prediction, but availability, especially the success in workouts in 62.
Exactly. He really stressed that their good run in workouts that year wasn't brilliant forecasting. It was simply that more good workout deals happened to be available then. Reinforces his focus on analyzing individual opportunities on their merits, not gaming the market. 1 year's performance. Minor importance, he said.
And it must have reassured partners seeing his own family's money increasingly tied up in the partnership, too.
Oh, definitely. He constantly pointed out how much of his own and his family's net worth was right there alongside the limited partners. Total alignment of interests. He was, eating his own cooking.
That offer of advance payments at 6% interest is interesting, but clearly not meant for everyday banking.
No, not at all. It was a safety net, really, for unexpected emergencies. He discouraged using the partnership like a savings account. The 6% was a convenience, not an incentive to move money in and out.
By 65, he's really pushing the importance of having clear ways to measure investment ideas.
He strongly believed anyone managing money needed a defined standard for success or failure. And crucially, both the manager and the investor needed to understand why that standard was right and over what time frame performance should be judged. All about discipline and rationality.
And 1965 is also when Berkshire Hathaway becomes a control. That started way back in 62 with buying undervalued stock.
That's right. Berkshire, this struggling textile company, became a control investment. He mentioned buying shares initially around $7.60, super cheap, reflecting how bleak the textile business looked. And he stressed they valued Berkshire as a business, not just a stock ticker, based on assets, earning power, what little there was then, industry conditions. Fundamental analysis.
Then he makes that really key distinction between conventional and true conservative investing.
Yes, this is classic Buffett philosophy. Conventional investing, he said, basically just moves with the market, up when it's up, down when it's down.
Yeah.
But true conservative investing, the goal is much harder, lose less than the market when it falls. Protecting capital on the downside was the real aim, not just keeping pace.
That long-term view really shines through not selling good businesses just because you guess the market might dip.
Absolutely. He saw stock quotes not as a reason to trade, but as an opportunity. If prices got silly, low or high, that's when you act. He always pointed to Ben Graham's The Intelligent Investor, especially Chapter 8, on using market fluctuations to your advantage, not letting them control you. Market's a voting machine short-term, weighing machine long-term.
But by the late 60s, things were changing. Finding those easy bargains got harder.
Yeah, the game got tougher. More competition, fewer obvious undervalued securities like in the early days. So he shifted focus a bit, looking for ventures that were, in his words, reasonably easy, safe, profitable, and pleasant. Maybe not home runs, but solid doubles. He also adjusted the long-term goal down slightly, the lesser of 9% a year or beating the Dow by 5 points. Realistic about the changing environment and their larger size.
And then the big news. He plans to retire from managing the partnership at the end of 1969.
A huge moment. He laid out plans to step back and distribute holdings like Berkshire and diversified retailing directly to partners. Importantly, he gave them the option to take cash instead, offering flexibility during the transition.
Early 70s, for those who stayed, the focus shifts towards bonds, but specific kinds.
Yes, for the partners who continued, he guided them towards larger, more liquid, safer bond issues. He warned about the hassle and potential bad pricing trying to sell smaller, less common bonds.
Insurance becomes a much bigger deal too. National indemnity, reinsurance, but cautious expansion. And then home and auto, which led to GEICO later.
Insurance became absolutely central. He saw the power of the float the premiums held before paying claims as investment capital. Aiming big in reinsurance long-term, but careful not to grow too fast when rates weren't great. Buying home and auto with Vic Rabe's strong management was key, paving the way for the big GEICO involvement later.
Mid-70s, diversified retailing merges into Berkshire. See's Candy keeps doing well.
Right, the merger simplified things. And See's, under Chuck Huggins, just kept churning out profits. A fantastic, simple business model, brilliantly run.
But the textile side of Berkshire, still struggling.
Yeah, despite Ken Chase and the team working hard, textiles were a constant drag. Tough industry, too much competition, couldn't earn decent returns on capital. Shows how hard it is to fix a fundamentally tough business.
He starts emphasizing return on equity, ROE, as a key metric for management performance, with an exception for businesses like textiles.
For most businesses, yes, ROE, how well management used shareholder money to make profits, was the main yardstick. But for industries like textiles with massive overcapacity, he realized return on capital employed, ROCE, which includes debt too, gave a better picture of true economic efficiency.
He also wasn't happy with their own home state insurance underwriting results in the late 70s, even when the industry was doing okay.
No, he expressed disappointment there. Their own results weren't matching the generally okay industry conditions, suggesting maybe some internal issues with underwriting or risk selection.
And all through this, his worry about inflation keeps growing.
He got increasingly vocal about it, called inflation a tapeworm, silently eating away at corporate profits, even if ROE looked okay on paper. He warned traditional accounting didn't capture the real damage.
Okay, into the 80s and 90s, the focus really sharpens on business quality and long-term value. GEICO's turnaround is a big example.
Oh yeah, GEICO's comeback from near death was amazing. It showed, 1, brilliant management stepping in Jack Byrne, and 2, the power of a fundamental business advantage Geico's super low-cost structure, a great business saved by great leadership.
He also flags an issue with insurance accounting carrying bonds at cost, not market value.
Right. He worried this could hide problems. If bonds fell in value but were still carried at their original cost, it could make an insurer look stronger than it was, maybe leading to dumb price competition because they thought they could afford it. Accounting doesn't always show the full economic picture.
A clear preference emerges for businesses that generate lots of cash without needing tons of reinvestment.
Yes, those cash cows. Businesses that throw off free cash that can then be used for other smart investments or given back to owners, not just constantly plowed back into the same operation, gives you huge flexibility.
But finding businesses good enough to buy outright was getting harder.
He admitted it was tough, finding great businesses, great management, durable advantages, and at a sensible price. Not easy. Showed how disciplined they were with capital.
He talks about the disconnect sometimes between reported earnings from minority stakes and Berkshire's actual capital gains because of market swings.
Yeah, the market's mood can make the stock price of companies they partly owned bounce around, even if the underlying business was doing fine. So Berkshire's reported results from those stakes could be lumpy year to year, not perfectly matching the underlying economic reality in the short term.
But still, they got comfortable owning both 100% of businesses and big chunks of others.
They're only flexible, happy to own great businesses outright, but also very happy to be large minority holders in excellent companies run by people they trusted, always looking for the smartest way to deploy capital.
And that policy of only issuing Berkshire stock when shareholders get equal value back, that seems rock solid.
Absolute non-negotiable for him. No issuing shares just to get bigger or do a deal if it diluted the intrinsic value for existing owners. Activity isn't progress, size isn't wealth on a per-share basis.
See's Candy, Nebraska Furniture Mart, their success is always linked to great products value and great management.
Consistently. He praised Chuck Huggins at See's, Mrs. B, and the Blumkins at NFM relentlessly. Great operators, understood their businesses inside out, totally focused on customer value. Perfect examples of what he looked for.
He's also very candid about the mistake with the textile business keeping it going too long.
Shows incredible self-awareness. He admitted his emotional attachment to the original business made him pour capital into it longer than made economic sense. A costly lesson learned about allocating capital rationally.
He had some sharp words for typical stock option plans, too.
Yeah. He felt many plans didn't properly account for retained earnings or the cost of capital. Options could reward execs just because the market went up or because the company reinvested profits, not necessarily because of genuinely superior management performance above a basic threshold.
And Berkshire's decentralized management style becomes really clear.
Absolutely. Find great managers you trust, give them autonomy, and get out of their way. That was the Berkshire model. Fosters ownership and accountability.
Low operating costs as a competitive advantage, Geico again.
The prime example. Geico's relentless focus on efficiency was its moat, allowing lower prices and market share gains. A powerful, durable advantage.
And holding on to core investments like Cap Cities, Geico, Washington Post, almost permanently, even if they looked expensive sometimes.
Very long-term view. If it's a truly exceptional business with great management and a strong moat, you hold on, maybe forever. Focus on the compounding of value over decades, not short-term market noise.
Tax law changes in the late 80s affected insurance investment income.
Yeah, tax changes impacted the after-tax returns from investments in their insurance subs and also changed the timing of tax payments, something they had to factor in.
See's Candy's extreme seasonality, almost all profit in December.
Yeah, quite unique. Shows the importance of the holiday season for them and the need for sharp operational management around that peak time.
The insurance float keeps growing, seen as key for future profits.
That float premiums held before claims are paid was a huge asset, billions available to invest. Its growth was vital, though he also warned falling interest rates would make the float less profitable to invest.
He admits it took him a surprisingly long time to fully grasp the importance of buying good businesses, not just cheap ones.
Fascinating self-reflection. His early Graham-style focus was purely on statistical bargains, sometimes leading to mediocre businesses. He learned over time that buying truly high-quality companies, even if not dirt cheap, led to far better long-term results. Quality matters.
And a general fear of long-term bonds because of inflation risk.
Consistent theme. He worried inflation would just eat away the real return from fixed bond payments over time. Too unpredictable.
The Berkshire annual meeting described as informative and fun.
He deliberately made it that way. Open Q&A for hours, honest discussion focused on educating owners. Very different from most stuffy corporate meetings. a real event.
Sell cheap and tell the truth. The motto for Borsheims and NFM.
He saw that as their core competitive advantage. Low prices plus total integrity built incredible customer loyalty and market power. Simple but powerful.
That WPPSS bond investment, buying distressed bonds at high yields. Opportunistic.
Definitely opportunistic, but calculated. Shows they'd step in when others were panicking, if the analysis showed the potential reward justified the risk. Contrarian value investing, even in bonds.
He really wished Berkshire's stock price would just track its business value. For the long-term holders.
Yeah, his ideal was shareholders who thought like owners, focused on intrinsic value, not traders obsessed with daily wiggles. He wanted the stock price to reflect the business reality, encouraging very little trading.
Breaking down reporting into 4 segments, that was for clarity.
To help shareholders understand the different parts of Berkshire, better insurance, manufacturing, retail, etc., and make it easier to estimate the overall intrinsic value. More transparency.
And highlighting those unreported earnings from investments, which led to look-through earnings.
Right. Accounting rules meant Berkshire's reported income didn't include its full share of the earnings from companies like Coke or Gillette that weren't paid out as dividends. Look-through earnings tried to give a truer picture of overall economic earning power.
The struggles at the Buffalo News in the early 90s, even with great management.
Yeah, despite Stan Lipsey doing a superb job in keeping a big news hole, the changing media landscape, falling ad revenue, rising costs was hitting newspapers hard. Industry headwinds.
Becoming a big player in super catastrophe insurance. Risky, but potentially rewarding.
Exactly. Taking on huge, rare risks others wouldn't touch. Why? It generated massive amounts of float to invest. But you had to be prepared for the possibility of enormous losses if a mega disaster struck.
Explaining float again and how falling interest rates hurt its value.
Crucial concept. Float is great, but its value depends on what return you can earn investing it. Lower rates mean lower returns on the float, making it less profitable for the insurer.
That analogy, owning stocks, is like owning a piece of a great business, needing patience.
Reinforces that owner mindset. Think like you own the whole company. Focus on its long-term prospects. Cites Coca-Cola, Gillette businesses with enduring advantages you hold for the long haul.
The need for independent thinkers on corporate boards.
He really believed boards needed people willing to challenge management, ask tough questions, truly represent shareholders, not just rubber stamp things.
Revisiting See's Candy, recognizing untapped pricing power, plus Chuck Huggins' management.
Key insight wasn't just buying a good brand, but realizing they could gently raise prices over time because the brand was so strong. And Chuck Huggins was the genius who executed that flawlessly. Management was critical.
Still emphasizing look-through earnings for a truer picture.
Just trying to give shareholders the most accurate view of Berkshire's total economic performance, including its share of profits retained by its major investees.
Buying shoe companies like Lowell and Dexter, mostly about trusting the managers.
A lot of it, yes. Confidence in the people running the show was a huge factor in those deals, the manager part of the equation.
Preferring negotiated deals for big blocks of stock, like convertible preferreds.
Often a way to put large sums to work on better terms than just buying in the open market. Maybe get a better yield or some downside protection. Strategic capital allocation.
And the reason for not splitting the stock? Attracting long-term owners.
Deliberate strategy. A high stock price discourages short-term traders and attracts investors focused on long-term business value. He wanted partners, not speculators.
Back to basics. Intrinsic value is future cash flows discounted back. Capital allocation and float are key.
That's the core valuation idea. What cash will this business generate over its life, valued today? How will management re-ingest that cash and the benefit of the insurance float are crucial inputs to that calculation.
Then, 1995, the Class B shares. Why did they do that?
It was mainly defensive. They saw these unit trusts popping up, packaging Berkshire stock but charging high fees, maybe not great for small investors. So they created the lower price B share initially, 130th of an A share, to give smaller, serious investors a direct, cheaper way to own Berkshire.
And to undercut those unit trusts.
Exactly. The 30-to-1 ratio kept the B share price still fairly high, in the thousands, to discourage tiny, speculative unit trusts. He was clear. B shares add to book value, but don't magically increase intrinsic value per A share equivalent.
Reassuring folks they wouldn't sell World Book despite electronic competition.
I believed it still had a unique value. Yeah.
And always emphasizing reading annual reports.
The best way, he felt, to really understand a business and its management's thinking. Homework for serious investors.
Candidly admitting the U.S. Air investment was a mistake.
That honesty again. Willingness to own up when things didn't work out.
The goal. Double intrinsic value every 5 years, but acknowledging it gets harder with size.
Ambitious target showed the focus on per-share growth, but realistic that the law of large numbers makes doubling huge sums progressively tougher.
And finally, the principle of retaining earnings if they can be reinvested well.
Key philosophy. Keep the profits inside Berkshire and reinvest them, but only if the expected return is better than what shareholders could get elsewhere, say, in safe bonds. Using a 10% hurdle when bonds yield 7% was his example. Don't retain earnings just for the sake of it. Reinvest them productively.
So wrapping up this deep dive into those early Buffett letters, what are the big recurring themes that just keep coming up?
You really see that constant focus on intrinsic value, the absolute need for a margin of safety, thinking long term. Also the importance of quality businesses, quality management, and really understanding what you own. And of course, that incredible power of compounding over time.
Right. And were there any aha moments for you? Things that really stood out as surprising or particularly insightful?
Well, that early focus on undervalued securities, almost ignoring the market, is striking. Then seeing how his thinking evolved, adding that emphasis on business quality, not just cheapness, that's huge. Understanding the float, not just as money owed, but as this valuable investment engine is key. And, the reasons behind things like not splitting the stock or creating the B shares, it shows this deep commitment to long-term partners, often completely against the Wall Street grain.
It really is amazing how relevant those ideas from decades ago still feel today, isn't it, for navigating our current markets?
Absolutely timeless. The principles he laid out back then, they're a solid framework for thinking about investing and building wealth no matter what the market's doing this week or next year. Hopefully you can think about how these might apply to your own goals.
Definitely. And maybe a final thought for you, the listener, to chew on. How could these core ideas, intrinsic value, long-term thinking, focusing on quality, apply beyond just stocks? Could they shape other big financial decisions or even, life choices where you're trying to build lasting value? Something to think about.
For sure. And we definitely encourage you to read Buffett's letters yourself. There's always more to learn.